You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for about the next, let's say, 17 minutes here on Options Playbook Radio. I want to start by reviewing what trade we looked at last week. Last week, heading into the big holiday weekend, it was a Friday, we looked at a VIX trade. The VIX was hanging right around the 16 level and talked a lot about the seasonality of the VIX. And usually when you get into September and October, if you look over the last 20 years, the VIX kind of spikes up in general, more so than it does in the other 10 calendar months. And so we were just kind of playing the seasonality of the market more than anything. And ever since September has hit, the market has had a tough time putting together an up day in the marketplace, and today it is actually down quite a bit. In the S&P 500 index, we're showing it down 96 points at this point in time, or 1.76%. So we're taping Options Playbook Radio. It is Friday and the markets are open. So in my VIX position, which I told you I did take a position in that trade, I did take half of it off. We see the VIX trading right now at 2276, but more importantly, the futures contracts are what is driving the position in the VIX option contracts with that September expiration. And the futures contracts, according to the CBOE delayed quotes, is trading just south of 21. Well, I shouldn't say just south. It's showing on the delayed quote system there at 2051. And by looking at the options contracts that expire in that month, that kind of seems to be right where the futures contract is trading at. Okay, so the trade that we set up, quick review of it, is VIX was trading around 16. We bought the 18 strike call, sold 2 of the 24 strike calls, and then bought 1 of the 29 strike calls. Now, you might not have caught this, but the long call spread in our butterfly from 18 to 24 is 6 points wide, and the short call spread from 24 to 29 is 5 points wide. What that does to the butterfly, and I like to call this an actual modified butterfly, is that if the market does skyrocket and does what it did in August in the VIX and shoots up to that 60 level, anywhere above 29, this trade is actually going to be profitable. When I put on the trade, I paid about 36 cents for the trade. And on Friday, when I talked about it on the show, it was trading around 20 cents. So I'm going to split the difference. Let's say we filled it for somewhere around 30 cents. And if that is the case, and the market did skyrocket above our protection strike, which is 29 on the upside, we would still be up a dollar on the trade that should be trading somewhere close to $1 minus the 30 cents paid, or about 70 cents on that trade. Now, the VIX right now is trading, like I said, on the futures basis, right around 20.50, very close to that range. And we actually see this trade at $1.43. So, in my position, I already took off half of that position today, and I'm going to let the other half ride a little bit. And the main reason why I took off half of it is because it is a Friday. I don't really want to ride it into the weekend. With the VIX, it's very hard to determine where you're going to end up after a weekend. It's hard enough to do it on a day-to-day basis, but after a weekend, it's very tough to try to predict where that market might open up on Monday. So wanted to take half of the position off, make sure myself that this trade will be profitable. And now I will trade the last few contracts by just letting it ride. We have until the 18th of September. So we have 12 days until that expiration date. Now, every day that goes by, there's going to be a lot of time decay in the VIX. So every day that you can make it and stay at this higher level is going to be a good day, and as far as this trade is concerned. So want to keep that bearish thing going on in September. And there was a trade that I looked at midweek on one of my shows, and that trade worked out because we were bearish, and it was the same type of concept that we put in on the VIX, and that it was a modified butterfly. So I figured today we'll do a rinse and repeat, and we'll get bearish going into next week using the S&P 500 index options. We're going to only go out until that next this coming up Friday. So we're taping on a Friday. So we're going to be looking at an option contract that has 5 full trading days to live. If we put it on today, I guess we could say 5.5. So Friday the 13th, that special day of the month, Friday the 13th, is when these option contracts are going to expire. So here's the trade, and we'll make this short and sweet overall. If you look at where the S&P 500 index is at right now, it's 5433 and some change. Market, like I said, is down heavily. We are going to buy the 5415 strike put and sell 2 of the 5400 puts, and then buy 1 of the 5390 puts. Now, once again, it's modified. We're going 15 points wide on the long put spread from 5415 down to 5400, and then we're going to go 10 points wide on the short spread, which will increase the cost. But with the VIX being so high, butterflies are cheap. So this is what kind of entices me on this trade. And the midpoint on it is $2.25. It's jumping all over the place. As I said, the market's moving. So that means that my total risk on this trade is $225 plus any fees to put that trade on. And the only way I lose is if the market does not get down to 54.15 and beyond. You'd have to take the break even into account, but you need it to go below that first put strike, and that's what your goal is here. So if the market stays where it's at or drifts higher, well, there is an adjustment we can make to the trade, and I would look to do that on this trade. But with this said, the outlook to start with is really like the market to get down to that 5,400 level. And I love the fact that that's a nice round number. So, because markets have a tendency to get to that number and then just kind of hang around a little bit and decide where it wants to go next. So I really like this setup on this trade. I am going to put this trade on in my account. Once again, I plan on putting this trade on before the market closed today. So right now, these are the numbers that we're going to use, and I will give you a quick summary of the trade. With the S&P 500 index down at this point, it's down $70 at 54.33. We are looking to the September 13th expiration, which is 1 week away. It's Friday the 13th is the expiration date. We are going to buy the 5415 strike put, at the same time sell 2 of the 5400 strike puts, and then go down 10 points only and buy 1 of the 53.90 strike puts. We're going to do this entire trade at a midpoint price of $2.25, which would be a real good fill in this SPX option contract. And that is going to be the paper trade for the week for Options Playbook Radio. All right, so we're going to be coming back next week. If you'd like to follow what I do on a weekly basis, now that I am actually not tied to a brokerage firm anymore, just go to x.com. My handle is simple. It's at my name, which is at Brian Overby, and follow along. If I make an adjustment on a trade inside that I actually have on inside my portfolio, I will tweet that out. And next week will be a very interesting week, to say the less. The marketplace actually, I meant to say this a little bit earlier, but the marketplace actually thinks that it's the jobs report that actually drove the market lower. I think it's seasonality. This is the one time I feel like the market pundits can say seasonality was the cause of this market move, and actually go back and look at the numbers and they can prove that person right. Usually when most pundits say that seasonality is affecting the trade, that means they got their forecast wrong and they have no explanation as to why they were wrong on their forecast. And I'll leave you with that note. X.com, at Brian Overby. See you next week for the next edition of Options Playbook Radio.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.